One of the great fears that many people face as they approach retirement is the potential to run out of money, to be a burden on other people to need to take care of them financially. In light of that, many folks prefer a stable, reliable income stream that doesn't go up and down with the stock market or bond market and can last a lifetime. So we're going to explore in our episode today different ways that folks try to address that issue.
So Spencer, today we're going to talk through a couple different ways that people can have a reliable income stream. So one of the big adjustments that clients often tell us about as they enter retirement is they've received a paycheck for the last 4 decades, a lot of them, and now they're entering a time where they have to draw money out of their savings. And so they've not only been receiving a paycheck, but they've also been putting away money month after month, seeing it grow. And now there's this emotional hurdle to then taking that money out. And I think there's a natural fear that our emotions get involved because we've been doing things in a certain way. So now it changes. And with all investments, there's risk. And so there's risk to drawing out. And if you remember our last episode, we talked about the 4% rule and some of those baseline assumptions of, okay, what can people draw out? But there's still that underlying fear of, am I going to run out of money?
Right.
So as we think about ways to produce reliable income streams, what are maybe some of those emotional hurdles that we need to cross first? And then what are maybe some things that we can think about?
Well, let's just remember that anytime we have 2 factors coming in play, our emotions are going to be heightened. One is that it's something that's really important. And having enough in retirement is really important to most folks. Any survey will tell you that. Second, if there's a high level of complexity, it also heightens our emotions. And so we have kind of a perfect storm coming together in here as we think about how do we create reliable income? Because as we saw in 2022, not even the bond market gives us a reliable level of income stability that many people crave. We saw the aggregate bond market in the United States go down 13% in 2022. And of course, the stock market was down as a whole even more than that. So that reliability is one of the things that we really want to dive into today. And we want to talk about not just the reliability of the income, but all of the factors around that folks have to grapple with and consider, because there's no perfect solution.
Okay, so let's talk about some of the risks that are involved. Longevity. We often joke with clients when we're talking about their Social Security benefit of timing. If they could just tell us when they're going to die, it makes it a whole lot easier.
Sure.
But we don't know the longevity of people. So do you want to talk us through what is that longevity risk?
Well, and it's underappreciated by a lot of the folks that we sit down with for the first time in their early 60s, especially if they're in excellent health. So if we look at this slide here and kind of walk through it, what you'll find is that for folks who are 65 and they're looking towards the future, there is a high likelihood that they're going to make it to 85, 90, 95 years if they're in excellent health and they're a non-smoker. Much higher than I think people really appreciate. We talked about in our last episode that 4% rule, looking at a 30-year retirement. That's what Bill Bingen looked at, assuming someone would retire in their early 60s to mid 60s and then have 30 years potentially. Well, what we find here is just jumping to the headline is that if we have a couple who is 65, each person 65, and they are in excellent health and they retire, there's about a 50-50 shot that one of them is going to live past 95. So that's an underappreciated longevity risk that we really find there. But to walk through the numbers, just generally speaking, for women who are in average health, they have a 57% chance to get to age 85. If they're in excellent health and they're a non-smoker, a 72% likelihood to get to 85. If we extend that out to age 95, again, they get to 14% and 31% respectively there if they are a general population versus a non-smoker who's also in excellent health at 65. The gentlemen don't live as long, as you can see there in the slide. They're less likely to live to age 85 or 90 or 95 than their female counterparts. But still, we look again at that couple number because we sit down with a lot of folks who are trying to plan for 2 lifetimes. And that is a really significant chance, again, that we're going to be planning for something beyond 30 years. Among the general population, 21% of couples will have 21% will have at least one or the other live beyond 95. So even if we don't have someone in excellent health, we still have a 1 in 5 shot that we're going to have a time period that is beyond 30 years. So something to really grapple with. And then even for folks who are in excellent health and non-smokers, about 1 in 5 couples will have one of them go to 100.
Yeah.
So that's, a 35-year period here. So that longevity is something, as we factor into the plan, that we need to bring front and center, because I can't tell you the number of people that we sit down with that say, okay, I'm 65 now. I can't imagine that I'm going to live beyond 85. Well, we're sitting with them, 20 years later, and we're seeing that they're not just 85, but they're in excellent health at 85. And we say, you might have another 10 or 15 years.
Right. And so really what that drives it back to is we need some of those reliable income streams. We can't put all of our eggs in Social Security. We can't put all of our eggs in our investments. So we really need a blend of lots of different strategies to really secure this couple or help them feel more secure. I think that's really the key of it. Is there's no strategy that we can put in place that's going to say, yes, 100% this is fail safe. Because we live in a complex world. But we want to bring people to a place of confidence, a place where they know that they have reliable income streams. So what are some of the uncertainties that people face when they think about that 30-year time frame?
Well, one of the other ones is inflation. So we don't know what inflation is. If we have income from Social Security, then we've got some inflation protection built in via those step-ups via cost of living adjustments. But let's just say you have a fixed pension and you take that fixed pension at age 65. If inflation is 3% over the next period of time, then in 23 years, your purchasing power is going to be roughly half of where you started. So you're only age 88 by that point, when that pension that maybe it started off at $5,000 a month or whatever number it was, well, you can only buy half as much in those dollars 23 years later. If inflation is 2%, so it's more manageable, it's, where we were at maybe before we had the COVID lockdown and such, then it's 35 years. 35 years later, it gets cut in half. So it still gets cut in half. It's just a slower time process. Now, if we had higher levels of inflation, we roll things back to, say, the 1970s and early 80s when inflation was much higher. If it's 10% per year, then in 6.5 years, your purchasing power gets cut in half, roughly speaking. So inflation is one of those things that's difficult to predict. What we can see is, if we look back on history, that inflation tends to be higher when we have out of control spending at a federal level. We see that not just in the United States, but we see that across lots of different countries. And we do have spending that is higher relative to our income on a federal level. We see that deficit increasing substantially each year. So provided that we don't address that in a timely way, inflation is likely to be higher than that 2% that we've been seeing on average prior to the pandemic.
And when we talk about purchasing power there, if your pension starts out at, say, $5,000 a month, when it halves, it's not saying your pension is going to go down to $2,500. What we're saying is that what it feels like, what you can buy, it now feels like $2,500.
Because if milk was at $5 a gallon and then it's at $10 a gallon, you can only buy half as much milk on that same dollar figure.
Okay, so let's talk about Social Security and just some of the basics of it, because there are really nice benefits to Social Security. It is guaranteed by the federal government. So the United States says that they are going to pay retirees every month. We don't know where Social Security is going. We don't know where the trust fund is going. It's set to run out in 2034. However, the government's still going to pay. It just may be a haircut. So if you want a deeper dive on Social Security, feel free to go back to some of our old videos and take a look at that. But what are some of the other basics of Social Security to know about?
Well, it really is the gold standard, because we think about 3 things that we'd really like to have in terms of our reliable income streams. First, we'd like to have it for life. So whether we live to 85, 95, 105, 115, it's going to be there. The second thing that we want to have is an inflation adjustment. We want to have that cost of living adjustment built in there. And then the third thing that we'd like to have is a risk-free payer. And you could argue that the federal government is basically risk-free in that they can go down to the basement, fire up the printing press, and voila, more American dollars are there. Now, you can make the counterpoint that maybe they're not worth as much if we get too far down that path, but still there is no credit risk significant relative to other insurers that are out there, or companies or institutions relative to the U.S. federal government. So we do make the point that Social Security, it could be cut. We think that that's really unlikely. We think that there's other solutions that legislators will, move down. But Social Security really is that gold standard of meeting those three key criteria.
Yeah. Okay. So now let's shift a little bit and look at what are some of the outcomes that people often look to and say, okay, this is a reliable income stream, and maybe what are some of the risks? So let's first talk about bonds and retirement portfolios. So where are bonds used as one of those safe portions of a retirement plan, and what risks are they exposed to?
Well, it's an important part of a lot of folks' retirement plans in that bonds are going to be more slow and steady as she goes, as the returns typically over time. They're going to provide an interest level of income. If we look historically, it's been a lower rate of return overall than stocks have given us when we think about long periods of time. But the ups and downs, the ride, is a lot smoother if we look back on history, much less volatile than stocks, those bonds. And because of that reliability, because of that kind of consistency, I should say, of income, bonds play a central role in a lot of folks' retirements. Now, that can be very, very helpful, but if we invest in a corporate bond or a U.S. Treasury bond, we don't really get any of those problems solved. We don't have, if we have a corporate bond, for instance, we don't have an environment where it's guaranteeing income for life. We don't have a step up in inflation protection, and we also have a little bit of credit risk there. So we have to look at bonds in a retirement portfolio and say, well, they can do a lot of things. They can help give us a steadier ride. For a lot of folks, that's all that they really need, is a steadier ride, making sure that they have enough, that our financial projections are good, for the time going forward. And if they sleep at night, we say everything looks like it's good from a financial planning perspective, that can be a very good path, because we're not taking those resources and there's not any kind of expense that might be for, an insurance contract or other kinds of things that's associated. And, they have oftentimes a higher interest rate for some of the corporate bonds than we see the U.S. federal government paying, for some of these other options.
So Spencer, one of the options that the federal government offers is the TIPS, the Treasury Inflation Protected Security. So walk us through what exactly is a TIPS and how can someone use one within their bond portfolio? Well,
just think about it as federal debt. So think about it as a U.S. Treasury bond in a similar way that you might have a 30-year or 10-year Treasury bond that's issued there. But now we've got a little inflation protection to it. So we've got a real rate of return, but then we've also got that pegged to an inflationary level that's going to be paid out over time. So there's a protection that's embedded in a Treasury inflation protected security, just like the name would imply. And these can be laddered in such a way that we can go out many, many years. You could have ones that mature here in the next few months all the way out to 30 years. So when we think about this, just generally speaking, we get a couple of those pieces now added. Again, if our gold standard is that we want to make sure there's no credit risk, that we have inflation protection, and that it's guaranteed for a lifetime. Well, we don't get all three, but at least a TIPS ladder that we're going to talk about here would give us the first two. There's not really any kind of risk that's associated with the credit risk of this. And then we've also got the inflation protection provided therein. It's not going to last a lifetime necessarily. So if we build a TIPS ladder out, we can really only go out about 30 years here. So again, if we have a person who's retiring at 65 and they live to 99, those last 4 years, we don't have a bond ladder that might be in place for them.
Right. All right. So Spencer, walk us through some of the dynamics of actually creating a TIPS ladder.
Well, a TIPS ladder, just like any other bond ladder, we're basically trying to match our liabilities, what we're going to be paying out, with a bond that is maturing at that point. So if we look out over the next 30 years, for instance, and we say, well, I want to have income that's about $3,000 on a month-to-month basis that's going to be indexed for inflation going forward, we can buy different bonds that will mature at different points such that, we have a certain amount of income that's going to mature. We have a certain bond that's going to mature, say this year, that is going to give us something like $36,000, that $3,000 a month. Well, we're going to need a little bit more next year. And that, because of inflation in all likelihood, well, we're going to buy one of those TIPS bonds that will mature again in a year. And then we'll buy another one that matures in 2 years, and then another one that matures in 3 years, and so on and so forth, so that every year we've got a security that is maturing that we have access to that, again, pays us what we need to be able to live on for that period of time.
Right.
So again, we have some wonderful pieces to that, in that there can be some inflation protection, all along the way. But we also have to recognize that we can only do it out for 30 years with U.S. Treasury inflation protected securities.
So thanks for walking us through that general overview of it. So let's presume someone has $500,000, $500,000 to invest in a TIPS ladder. What kind of ladder can you build? And then what kind of return can you expect, especially in the beginning?
Well, and all of this is going to be generalized. These real rates of return that we're talking about, they move around on a day-to-day basis, and not just, it's not uniform. It's not as though a 1-year Treasury inflation protected security is going to be identical to a 30-year in its real yield at any time, because it won't. So we've got to take all of this with a grain of salt. So we kind of strip down our expectations, though, and say, okay, if we have a 2% real yield on a series of TIPS investments that go out, and we're targeting 30 years for that ladder, then roughly speaking, you could take out about 4.5% of the initial amount and be able to continue to withdraw that year to year going out 30 years. So you might be able to take out about $22,000 from that initial amount of $500,000 and expect that, generally speaking, you're going to be able to take out a little bit more each year that's going to adjust for inflation along the way. If we only had a 1% real yield, so if we think back historically, there have been a lot of periods where we don't have, as we sit here today in early December, it's about a 2% real yield, but there have been a lot of periods where it's 1% or 0% or even sometimes negative.
Right.
But if it was only 1%, then we could take out a little bit less than 4% at the start. So we could take out a little bit less than $20,000 of that $500,000 if we had a 0% real yield on TIPS. Then we could only take out about 3.5% at the start if we were expecting, again, for it to go 30 years. So, we've got a lot of different things to consider here. Now, if our time frame was a little bit shorter and we only had 25 years that we were targeting, then you might expect that if we have a shorter time period that we can take out a little bit more. So you can take out a little bit over 5% by our calculations if you have a 2% real yield on TIPS at the beginning. If you're only targeting 25 years, again, if you're targeting 25 years and a 1% real yield, then you could take out about 4.6%. And then if you've got 25 years and have a 0% real yield, then you can only take out about 4% again. So in none of these scenarios, though, do we talk about a 35 or 40 year retirement. So if we have a 62-year-old that retires, we really need to explore the potential that he or she could be doing this for 40 years. And a TIPS ladder struggles to keep up with that, oftentimes with people's expectations.
Right.
Because that's a lot of money to have positioned very conservatively.
Right.
There.
So let's come back to that then and say, what are some of the common mistakes that people make? Or what are the common misunderstandings that people make when they think about TIPS ladders?
Well, TIPS they're complex, and the way that they're priced and all of the moving parts are complex. So I can't tell you the number of times that people will miscalculate what the TIPS security costs in a given moment, what they're expecting inflation to be. There's all kinds of different pitfalls of building one of these things out. But we do this just we're using this really as an exercise to explain, this is one of the ways that you could approach this. We're not suggesting that you do this unless you really, really dive into the details and understand them. There's a lot of different ways that you can run afoul in trying to build one of these out. So miscalculating inflation or miscalculating general pricing is very, very easy to do. Second thing, ignoring tax implications. So they do accrue interest and inflation adjustments, which are taxable, but that's not always intuitive. Because we've got that inflation component put in, oftentimes the way that these are taxed is not intuitive to a lot of investors that are out there that are not haven't done quite as deep a dive. And then finally, the last thing you could say would be a limitation would be rather poor diversification. So if we're concentrating our tips too much on investments that have similar maturities, you might say, okay, well, I'm just going to put $500,000 in, and it's going to be all in bonds that mature in 25 years. Well, that's not what we're talking about here. Again, because if we have a bond that we're trying to sell that matures in 25 years, if interest rates move around a whole lot, the price of that bond is going to move around a whole lot with it. And if in a year you're looking to harvest that income, you're going to have to sell that bond, and it may be up or down from where you would have expected. Whereas if you've built it correctly and that bond matures, or that security matures in a year, then you're going to be at a much more secure and stable space in terms of getting what you need.
Great. All right, well, Spencer, thank you so much for walking through that tips ladder and just some of the common pitfalls and mistakes that people can make. How does this compare to some of the other investments that are out there that people may have heard of or seen on TV?
Well, there's a lot of focus in some circles about using annuities to guarantee lifetime income, and that is one option that's out there. When we think about annuities give us two of the three primary considerations, but they're different. So whereas we have really a risk-free environment in tips and we have inflation protection, annuities give us a lifetime guarantee or a lifetime reliable income. But the factor there that they don't have is the risk-free environment. Because if you have a company that's guaranteeing that investment, if the company goes under, then you may not have that income stream. And we have to grapple with that, because you might be making that investment and you might be pushing those funds into either an investment vehicle or some kind of an annuity there. And you might be trusting that the company is going to be there in 40 years, 35 years. So if we look at strong companies, we have a much higher conviction that they'll be there in a year than maybe they'll be there in 35 or 40 years. So we do have to grapple with that credit risk on the annuity side, but it is typically for a lifetime. And there are different types of annuities that are out there that provide some step-ups. Some do and some don't, but we'll be diving into that next time that we get together in our next video.
Great. Well, thanks. Hope you enjoyed this video. If you have any questions, feel free to reach out to us. As always, take some of this information to your financial advisor. Ask them questions about tips ladders or reliable income streams. And with that, we'll see you again next time. If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.